On Point with Craig's Investment Partners.
The information provided here is general in nature and it's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risk and none are guaranteed. So before you make any decisions, we recommend you contact an investment advisor. For more information about our services or to view the Craig's Investment Partners Financial Advice Provider Disclosure Statement, please visit our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. A question I get all the time is, should I pay off the mortgage faster with that spare money, or should I use it to invest? Very common. A lot of people think about this. It's especially relevant today because while mortgage rates are down from the highs of 2023, they're still above the average of the past 15 years. And let me just say right off the bat that this question is only relevant if you're a disciplined saver. Because if you're not, and you're inclined to just spend any spare money rather than investing it, then you should probably pay off your debt as quickly as possible. Because for those of us that have a tendency to give in to temptation, paying off the mortgage can work like a forced savings scheme, and that is exactly what a lot of us need. For others, it is really difficult to give a definitive answer, as it's not completely black and white. On the one hand, paying down the mortgage as quickly as you can is sensible, and it will set you on the path to financial freedom. It'll also allow you to borrow that money back later. And if you do that to invest in income generating assets, and that could be an investment property, it could be a business, or it could be a share portfolio, that interest then becomes a tax deductible expense, unlike the original mortgage on your family home where you live, where that is not tax deductible, that interest bill. And when you do that, that can make for a very tax effective way of structuring your borrowings, because those borrowings are cheaper, because the interest burden is tax deductible, which essentially means it falls by 39% or 30% or whatever, depending on what the income tax rate you pay is. However, using some of your spare money to invest along the way can also be very wise. Let's look at the numbers. The best 1-year fixed mortgage rate at the moment is just below 5%. So if you make additional payments on your mortgage, that is essentially the annual return that you're getting on that money. That's the way to think about it. Your other options for putting those funds to work, if you're not going to pay down the mortgage, will give you a varying range of returns. Let's start with term deposits, a very low risk option. At the moment, the 1-year advertised rate is about 3.8%. That's before tax, obviously. Now, apart from your liquidity buffer or your emergency fund, there's not much point leaving excess money on deposit at 3.8% if you've got a mortgage costing you 5%. So if term deposits are the alternative, you may as well just pay that mortgage off more quickly. On the other hand, managed funds, shares, and property will all offer much better returns than term deposits, but they will have a higher risk profile and they will mean more volatility. So shares, either here in New Zealand or in the US or somewhere else, they've delivered annual returns of between 8 and 11% per annum over the past 30 years. House prices, they've risen about 6% per annum over that same period. Now those gains, for all of those assets, they are above the current cost of borrowing, and they're higher than where mortgage rates have been for the bulk of the past decade. However, just like any growth asset, the gains won't come consistently. For the share market, we've seen numerous ups and downs over those 30 years, including 4 big declines of more than 25% each. House prices have also been in an extended slump, and they're still more than 15% below 2021 levels. Now, in time, markets recover, we all know that. So in hindsight, we actually look back on those difficult periods quite fondly because we recall the opportunities that we were able to take advantage of. However, those rough patches can be very, very disconcerting when we're in the thick of them. And in contrast, the return, and I'm saying return in inverted commas, the return one gets from paying down the mortgage is free of risk, free of volatility, and free of uncertainty. So if that 1 year fixed rate that you're paying on your mortgage is 5%, then the interest you'll save, which is the return, it's not at the mercy of economic conditions, politicians, policymakers, market sentiment. It is 100% rock solid, and it's guaranteed. And that is why the textbook or an Excel spreadsheet or maybe your purist accountant friend might all say that paying down the mortgage makes sense, because there's nowhere in the investment world where you will find a similar return for zero risk. There is not a 5% return out there at the moment that is risk-free and guaranteed and free of volatility. So that is the difference. However, it's never that simple, is it? And this still isn't always the right approach for everyone. Doing a bit of investing on the side can be a very good choice for many of us, even though the textbook might sometimes suggest differently. Maybe you'll catch a wave of great returns, maybe you'll make more than you would have saved in interest. And even if you don't, I think the knowledge that you've gained by educating yourself about money, about markets, that could really prove invaluable. What we find is that when people have skin in the game, they tend to pay much more attention to something. So if you've got a few investment interests, even small ones, that will often give you the motivation to follow the economy more closely, to read the business pages more often, and to learn about how financial markets work. So even though you're not likely to find a better risk-return proposition than making additional mortgage payments, you will learn a lot, and that will put you in very good stead to make better decisions in the future. So if any of this is interesting, if it's hit a nerve, talk to someone, find a good investment advisor, a good financial advisor, and have the conversation, because the answer is not always the same for all of us. We're all different. We've got different risk profiles, different drivers, different objectives. So you want to do what's right for you, not necessarily what's right for everyone else. Hopefully that's a bit of food for thought. Hopefully it gets you thinking. Maybe it even answers a few of your questions. Thanks for listening, team. We'll talk again soon.
For more insights, visit craigsip.com.